Hi, good morning, everyone. We'll start the webinar now. Paul is not here today, so we'll be skipping the first few slides and we'll go straight into CNMC Goldmine company results by Guangzhi.
Hi, it's Guangzhi here. So I will give updates on CNMC's and Golden Energy Resources first Q results. So now let's take a look at CNMC Goldmine Holdings. Okay, we upgrade our call from hold to buy with a higher target price of 42 cents, and the last end price was 27.5 cents. So you can see here the first Q results improve significantly, mainly due to the increase in production and sales volume, and also the growth of ASPs. So for the business, in March, CNMC announced the first gold pour from SIA plant, which deliver a substantial improvement in production. So you can see here the first gold pour arrived at 863 ounces by 2 weeks operation. So based on the processing capacity of 500 tons, we can derive the implied ore grade of this high-grade ore, which arrive at 3.1 gram per ton to 3.5 gram per ton. So this is quite a big improvement compared to the existing plants such as wet leaching and heap leaching. So over the past few quarters, the implied ore grade was only 0.3 gram per ton. So I mean this is the current ore grade from the CIA plant was 10 times the lower ore grade plant. So and for the CIA plant's cut-off grade operation, for the CIA plant's operation, the cut-off grade is about 1 gram per ton. That means only when the ore grade are above 1 gram per ton that are delivered to CIA plant to process is meaningful for CNMC to run the business. So as of now, CNMC already preserved quite a few amount of high ore grade. So we expect the next few quarters the production will continue to improve year on year. So the next is about the political environment impact. So we think that the business will remain unchanged because the provincial or state government remain unchanged. So because of all these concessions as well as the leases were signed a few years ago, that means moving forward there won't be much change on these terms and contracts. So moving forward, we expect both operating and non-operating costs will increase. This is because CNMC will increase its manpower as well as the procurement of the consumables and chemicals for CIA plant. As of now, CNMC is operating 3 projects at the same time: the CIA plant, the heap leaching plant, and the wet leaching plant. And also, it continued to explore the Calgo project and the Pulai project. So that means the operating expenses will continue to grow. And also, previously, CNMC already announced the purpose of dual primary listing in Hong Kong. And in first Q, they already deposited $0.18 million to the Hong Kong side. And based on the preliminary assessment, the total expected listing fees wouldn't exceed 5 million Hong Kong dollars. So the outlook for CNMC is good. We think this year will be a big turnaround for its performance, since we expect the output as well as the gold prices will continue to improve. The next is Golden Energy and Resources. So we maintain our buy call with unchanged target price of 48 cents, and the last done price was 37 cents. So you can see the results here. The first Q results were quite phenomenal. As you can see, all these profits were above like more than 40 or 30, more than 40% growth year on year. So this was because the substantial increase in production volume. You can see here year-on-year growth in first Q arrived at more than 56%, and the ASP continued to grow by 16%. So as a result, the top line, especially from the coal mining segment, increased 83%. So the first Q, in the first Q, Gear was upgrading the port loading capacity. So there are two conveyor belts at Bonati Port with a capacity of 1K tons per hour and 2K tons per hour. And these two conveyor belts capacity will be upgraded to 4.2K tons per hour each. So which will translate into total annual capacity of 48 million tons. Meanwhile, the company is also conducting the road widening project. So right now, there are only 2 lanes on the road to the jetty to this Bonati port. So after this project is completed, the 2 lanes will be expanded to 4 lanes. So that means this will improve the traffic conditions accordingly. So the negative in this quarter was the higher cash costs. This was mainly due to the increase in the strip ratio in BIB mine from 3.5 to 4.3. So please take note here, the average life of mine strip ratio in BIB mine is 4.1. So we expect that the cash cost will remain at $25 to $26 per ton in FY18. However, we remain our forecast of coal prices unchanged, which will be $40 to $42 per ton, and the annual target of 20 million tons is still on track. So that means these two are positive factors combined together is expected to offset the increase of cash costs, and also the acquisition of BSL mine is expected to be completed by 3rd Q this year. So we expect that some of the production will be contributed by BSL mine as well. So next I will pass on to Richard.
Hi, good morning everyone. This is Richard speaking. So we'll talk about SIA Engineering's results now. We maintain accumulate. Target price is higher at 357. It was 351. For FY19, we are forecasting the same level of dividend, 13 cents. That will give a 3.9% yield based on last Friday's close at 331. So we'll talk about the results numbers now. If you look at revenue is flat, but negative 0.8% year on year. That's due to lower revenue from the fleet management segment. Reported EBIT is 6.1% higher year on year. There was a one-off provision made in first quarter of last year. So if you adjust out this one-off staff remuneration entry, then the adjusted EBIT on a recurring basis is actually lower by 18% year on year. Just take a look at these two lines for EBIT and associates and JV. You can see that associates and JV actually contributes more to the bottom line than the core company EBIT. So that's why we always look at what's going on for the associates and JV as well. So for this year, associates and JV was almost 14% higher year on year. Associates contribution was 7% higher to almost 70 million, and JV was 28% higher to 40 million. So most of the growth actually came from joint venture. For reported PATMI, there were one-offs in both FY17 and FY18, but the reported PATMI is lower by almost 45%. This year there's a one-off of 14.3 million surplus on disposal of associated companies. So this year's PATMI is exceptionally higher, and which would be adjusted downwards. And last year, FY17 also there was some one-off gains, so it's also exceptionally higher and will be adjusted downwards. So if we adjust both of them by their one-offs, on a recurring basis, PATMI is actually only down 1.3% year on year. We'll talk about the bullet points now. So for higher JV contribution, this was due to more of the Rolls-Royce Trent engines going in for the shop visits at Seychelles. That's their joint venture with Rolls-Royce. Guidance from management is that more engines will be coming in, but they did not provide any details on where the joint venture profit level will reach or timeline of how this new timeline of all these jobs coming in. So for dividend wise, there's a proposed final dividend of 9 cents and no special dividend. Last year also was 9 cents final, and there was a 5 cents special dividend. So I mentioned already that last year there was some one-off. So last year there was some one-off divestment gains, so that's why there was a special dividend last year. For interim dividend wise, it's the same. It was 4 cents this year and last year. If you look at it from a payout ratio point of view, payout ratio this year is about 86% and it's remained stable. So last year was about 85% and the 5-year average is 86%. So despite the difference in the number of cents you receive, but on the ordinary payout ratio basis is been stable the last 5 years. The core company EBIT remains weak, and with the lower revenue, it was compounded by higher OPEX, and that led to the drop in EBIT. there was some impact from the weaker US dollar as well, which depreciated about 2% relative to Singapore dollar during the year, and this resulted in currency translation loss, and that lowered the book value of equity by almost 60 million. The outlook for SIA Engineering is improving, but still remains challenging. So we think that profit recovery will be L-shaped and not V-shaped, and also competition is not abating. Now we move on to our sector report for industrial REITs. We are maintaining equal weight view on this subsector, and we have also looked at the recent JTC data that was published for first quarter this year. There was a marginal improvement quarter on quarter for the sector occupancy, but rental index is lower quarter on quarter. Across the board, rental index has yet to bottom, but business park has made new high. There's also a tapering. There's tapering supply in 2018, and so we think that rents should bottom by the end of this year. Also take note that the announcement for the acquisition of Viva by ESR REIT was made. The announcement was made on Friday. We'll talk a little bit about that. First thing, we'll look at the data from JTC. On the left is the latest one for first Q 2018, and on the right is the previous quarter's one, fourth quarter 2017. If you just take a quick glance through and count the number of green arrows, you can see that this quarter number of green arrows is less than the last quarter. So superficially, that would suggest that we have not seen the bottom yet, and still the situation is still trying to stabilize. As mentioned just now, if you look here, the rental for aggregate has come down quarter on quarter, but occupancy has ticked up, so at least we are still seeing some soaking up of supply. So these key takeaways are in terms of the results for the quarter ended March. Our report has been slightly delayed because of Viva Industrial Trust, which also reported their first quarter results later than usual. There was some positive sentiment during the quarter, so this coming in terms of rental levels. So one of the manager commented that signing rents during the quarter were higher compared to 6 to 9 months ago on the same asset basis. There was some slight tightening of capitalization rates, specifically for Ascendus REIT, Mapletree Industrial, and Mapletree Logistics. So they enjoyed some fair value revaluation gain on their investment property portfolio. In terms of manager expectations, is a mixed bag for 2018. Mixed bag in the sense that is dependent on which property type we are looking at. So generally among the managers, there's optimism for business park and high-tech, high-specs buildings, and caution for standard industrial space and warehouse space. And rental reversions during the quarter were generally negative, but managers expect rents to bottom in 2018. Even the blue chip REITs like Ascendas and Mapletree reported negative reversions for their Singapore portfolio. So some property types within their portfolio, of course, had positive, some had negative, but on a weighted average basis for their Singapore portfolio, they were negative. Now we'll talk about some of the major events recently. First is the acquisition of Viva Industrial Trust by ESR REIT. So ESR REIT will acquire Viva Industrial Trust for 96 cents per stapled security. That is a 26% premium to NAV for VIT. How they will pay this is 10% in cash and 90% through issuing new ESR REIT units at 54 cents per unit. So for example, if you own 100 VIT stapled securities, when the transaction, if the transaction goes through, you will get $9.60 in cash and 160 new ESR REIT units. There's also been some acquisitions of platforms by two of the REITs, that's Frasers Logistics Trust and Mapletree Logistics Trust. So for Frasers Logistics Trust, they are acquiring 17 properties in Germany and 4 in the Netherlands. They've already had the EGM and have shareholders approval to go through with the acquisition. For Mapletree Log, they are acquiring 50% interest in 11 warehouses in China. This will grow their portfolio to about 6.8 billion Singapore dollars. The other thing is for Sabana REIT, the manager has, in the recent AGM, the manager has managed to get back the general mandate. So what that means is that the manager has the discretion to issue new units, and so the manager can pay the manager fees in units. Thus, that will help to retain cash within the REIT, and then that will fund their rejuvenation strategy through AEI. So what the current strategy that the manager is adopting is divesting non-core assets, and then the manager also wants to upgrade its flagship property, New Tech Park at Lorong Chuan. So this kind of AEIs cost money. The other one is for Soybuild REIT. One of their tenants, Thales Marine, had defaulted, and so the manager made the decision to early terminate the lease and has managed to backfill the property to 34%. So the manager has a 18 months security deposit, and that will be able to help them to buffer this lower occupancy. So the manager says that it's able to maintain the property NPI for the most of 2018 by using that security deposit. For investment action, we maintain equal weight. Tailwinds is a tapering of supply in 2018. Headwinds is negative reversions to continue into 2018. So organically, this would mean a lower revenue, but for REITs that have done acquisition, then of course, if the acquisition is big enough, then the revenue growth from acquisition should offset these negative reversions. As I said before, we expect rents to bottom by the end of this year. Why equal weight and not overweight is that occupancy, that it hasn't been a broad-based improvement, so we would like to see a broad-based improvement in occupancy before we give overweight for the sector. We currently cover 4 of the industrial REITs. That's Ascendas Cash, Capital DC, and Mapletree Industrial, and out of the 4 we have accumulate on Ascendas Cash and Capital DC. Okay, so this slide, there's no change. It's exactly the same as what you have been seeing for the past few quarters. Strategic top-down view is for exposure in business park and science park properties and high-tech, high-specs buildings. Now we'll talk about key points on the individual 4 REITs under our coverage. So first thing is there was a rating change for Capital DC. After the results, we have maintained at neutral, but subsequent to that, they made the announcement of acquiring Kingsland Data Center Private Limited. So with that acquisition, we upgraded Capital DC to accumulate. So after the acquisition is complete, the AUM for Capital DC will be increased from 1.66 billion to 1.97 billion. So this is just short of the 2 billion AUM target that the manager of Capital DC REIT has repeatedly articulated. This acquisition will be funded through private placement, and it's expected to be completed in the second quarter of this year. The REIT also will have some inorganic growth this year. That's from Capital DC Dublin 2, which was acquired in September last year, and Main Cube's data center, which was acquired this year. For Ascendas, portfolio remains high at 91.5%. That's higher than JTC average. WALE also is healthy at 4.2 years, so that gives income visibility. There was a slight tightening of cap rate during the quarter that resulted in positive fair value gains on the investment property portfolio, and 55% of the REIT's net property income comes from business park and high specs properties in Singapore. We think that contribution from recent acquisitions can help to mitigate the renewal risk that is currently standing at 14% of portfolio gross rental income. For cash, Commodity Hub was converted to a multi-tenancy after the first quarter, and then it has a 86% occupancy, which is lower than the JTC average. Current gearing is 38.5, but that is expected to reduce to 32.5 because they're divesting 40 Alps Avenue, and that will be used to repay debt. Renewal risk for the remainder of 2018 is about 6.7% of gross rental income. For Mapletree Industrial, occupancy was lower. This is the effect of one of their speculative new build coming online and added into the portfolio. And then there was a slight tightening of capitalization rate as well. So for this 38 Kallang Place, it's now currently 40% pre-committed, and manager will be ramping up occupancy in the quarters ahead. There's also the build-to-suit data center, which will come on stream in 2018 this year, and that platform of 14 US data centers should contribute positively to this year as well. So expectations wise is managers expecting softer leasing from flatter factories, while business park buildings to remain fairly strong. Just run through the next few slides quickly. So this is showing the 1Q data for the aggregate sector. Left side is showing the occupancy, right side is showing the rental index. You can see that occupancy has ticked up a little bit, and rental index looks to be stabilizing, but quarter on quarter is still lower nonetheless. Same thing for factory wise, you can see it's generally downtrend, but looking to stabilize. Business park occupancy had a slight dip quarter on quarter, but rental index wise, it's making a new high. For warehouse, occupancy is slightly lower quarter on quarter, and rental index also still going lower, but the speed of the descent is slowing, as you can see. This chart on the right shows the upcoming supply pipeline for factory in dark blue, warehouse light blue, and business park in gray. So for remainder of 2018, we're expecting 1.6 million square meters of space coming out. To put that into perspective, the annual demand over the last 3 years was 1.3 million square meters, and the supply was 1.8 million square meters on average in the last 3 years. So the supply that's coming out this year is lower than the average of the last 3 years, but nonetheless is still higher than the demand, average demand over the last 3 years. Overall supply pipeline is tapering off this year. This chart is just showing the percentage growth for each of the segments in terms of space. On the demand side, the left chart is showing the PMI, the right side is showing the industrial production index. So for PMI wise, you can see first 3 months, overall PMI has been stable, but electronics PMI has already peaked already and starting to moderate. We have been saying since last year to expect moderation for this year due to high base effect in 2017. For the industrial production as well, if you look at the year on year, which is the dark blue line, February and March is already lower than the growth rate in February and March is for this year is lower than the growth rate in February and March last year. But January 2018's growth rate is higher than January 2017. This is just a snapshot of the results for each of the industrial REITs this quarter. If you look at the DPU summary here, those that showed DPU growth, generally the blue chip ones like Ascendas, Mapletree Family, and Fraser's Logistics Trust. The other blue chip one that didn't have DPU growth was Capital DC REIT, but they had some equity raising which diluted the unit holder base. This for full year, almost the same. You can see for DPU growth, which is the last column, is the blue chip REITs that have been able to deliver on DPU growth. This is the operating statistics for the sector. You can take a look at it for your own reference. Here, what this shows on the left is the updated chart for trailing price to NAV multiple and the trailing yield. So this was as of 18 May, and each chart from going to the right is the one from the previous quarter. So here you can see how it has changed over the last 1 year, since May 2017 to May this year. So if we look at trailing yield wise, you can see that yield has compressed from 7.3 to 7, and for price to book, it's actually gone from 1.1, and it's actually been accorded a higher premium all the way up to 1.13, but now it's come back down to 1.11. So that's why we say that year on year, yield has compressed, but valuation has remained stagnant. This is just a graphical representation of the previous table, where we are plotting the trailing yield against the price to book. So not much change from the previous quarter, in the sense that again, the blue chip industrial REITs are at the bottom right corner, where they have the highest price to book and they are trading at the tightest yield. One of the major movement is for ESR REIT, which was somewhere in the middle, but now is moved up towards the left. Okay, we have come to the end of the webinar. We'll pause for questions now. There's a question on capitalization rate. Okay, we are going to explain this again. Tightening of capitalization rate means that the capitalization rate is a smaller number. Smaller number, all things equal, means that the property value has gone up if the net property income remains the same. So the positive thing is property value goes up, but the negative thing is that it becomes increasingly difficult to acquire accretively. Yeah, there's a question on Asia Pay TV. Paul is not in Paul is not in office today. He's on urgent leave, so that's why we skipped that slide on Asia Pay TV. Okay, there's a question on the ESR and Viva Industrial Trust. The deal. Okay, so as I'm okay, here is 96 cents. ESR REIT will acquire Viva Industries Trust for 96 cents. If you are a serious investor, then you should buy the ESR REIT share, because if you buy the Viva one, for the same amount of money you put in, you're going to get back some cash. So that defeats the purpose if you want to deploy that amount of cash into the investment. So by right, today Viva Industrial Trust should trade at 96 cents and ESR REIT at 54 cents. But as you can see, the current price is lower than 96 and 54. So what we think is that the market is actually pricing in some possibility that at least one of the EGM will not go through. So as you know, both the ESR REIT shareholders and the Viva Industrial REIT shareholders will have to vote in an EGM on this. So if just one side don't go through, then the whole deal will not come through. So of course 96 cents will be the theoretical price for Viva Industrial Trust shareholders to exit. But the thing is that if either side vote no, then the shareholders will not get to see this 96 cents. So that is one of the a risk involved, and that's why we think that the prices today are not at 96 and 54.
Hi everyone, Hong here. There's another question on a follow-up question on the cap rates. So the question is, what determines the tightening of cap rates? Is this determined by the company? So the cap rate is a function of a lot of factors. It's not determined by the company. It's a function of your general interest rates in the environment. In particular, if you look at the last few years since post GFC, you see that across most asset classes, the cap rates have been tightening for retail, for offices, industrials, and that generally is a function of the fact that interest rates have been low and have remained low, and so there's a good deal of liquidity and money supply in the system going after different asset classes, and that generally has pushed down yields. You look at bond yields and yields across a lot of different classes in different geographies. Generally, most of them has been pushed down. So it's a function of the supply of money in the system, how much money is chasing assets, interest rates in the interest rates generally across the board. So it is not determined by the company, it's more of macroeconomic conditions.
Hi, there's a question for SIA Engineering about the Rolls-Royce Trent 1000 engine issue and how they impact SIEC's overall joint venture. Okay, we during the results briefing, management did mention that the Trent 1000 did contribute positively to the positive joint venture results, but there was no breakdown on how much of it is directly attributable to that and how much is it due to just increase in volume in general. So specific on how that issue impacted the earnings, we don't have an answer for that.
Hi, we had a question. We had a question on the slides that we used during our presentation on Saturday at the REIT symposium. Our slides will be updated over the next few days on our homepage, the stocksbnb.com. Thanks for your patience.
Hi, it's Gonza here. There is a question on among the co-peers, Gear, Geo, and Black Gold, which one rated highly? So we don't have coverage on Black Gold anymore. Right now we have both buy on Gear and Geo. And also there is another question asking about whether there is a free website that the investors can look up for the price of 4,000 to coal. So previously I already showed the website coal spot, which I will show here. So this is a website you can check the HBA, which is the Indonesian coal price reference. So you can check the here. This is the ICA. So you must register. So here you can see the 4,002 gut, which is the echo coal here, the price, and you can choose the month, like the period, or this. Thanks.
Hi everyone, we do not see any further questions. If there are no further questions, we will call an end to our webinar today. Thank you all for attending, and we look forward to seeing you guys again next week. Bye bye.